The Enron scandal is one of the most infamous financial scandals in history. It involved fraudulent accounting practices that ultimately led to the bankruptcy of the energy company Enron. This scandal had far-reaching impacts, not only on Enron's employees, shareholders, and business partners, but also on the overall public trust in corporate ethics. The Enron scandal serves as a cautionary tale about the devastating consequences of unchecked fraudulent behavior. Enron was once a highly admired and respected company in the energy sector. Founded in 1985, it rapidly grew into one of the largest and most successful energy traders in the world. However, behind the scenes, Enron was engaging in a series of deceptive accounting practices that masked the true financial condition of the company. These practices allowed Enron to inflate its profits, hide debts, and deceive investors and regulatory authorities. One of the key techniques used by Enron to manipulate its financial statements was called mark-to-market accounting. This accounting method allowed Enron to estimate and record the value of its long-term contracts and investments as if they were immediately profitable, even though the actual profits were uncertain and sometimes non-existent. By inflating projected future earnings, Enron created an illusion of financial success and stability, attracting more investors and inflating their stock price. Enron also established several off-book entities known as special purpose entities to hide their debt and manipulate financial statements. These SPEs were created to hold the company's assets and liabilities off the balance sheet, allowing Enron to portray a much healthier financial position than it actually had. By keeping the debt hidden, Enron executives were able to maintain their inflated stock prices and continue their fraudulent activities. The impacts of the Enron scandal were devastating. Thousands of Enron employees lost their jobs, retirement savings, and pensions when the company collapsed. Investors lost billions of dollars as Enron's stock plummeted from over $90 to less than $1. Confidence in corporate governance and financial reporting took a severe hit as the scandal exposed the failures of both internal and external controls. Regulators and lawmakers were forced to reassess the regulatory framework to prevent such fraud from happening again. The Enron scandal had unintended consequences that rippled through the economy and regulatory landscape. The reputation of accounting firm Arthur Andersen, Enron's auditor, was irreparably damaged, leading to its collapse. The Sarbanes-Oxley Act was enacted in response to the scandal, introducing stricter regulations and oversight requirements for public companies. Additionally, the scandal led to increased skepticism towards corporate financial statements, driving a demand for transparency and accountability. The Enron scandal has taught us valuable lessons about the importance of strong corporate governance, ethical leadership, and effective regulatory oversight. It exposed the dangers of unchecked power and unethical practices within corporations. It highlighted the need for transparency and accountability in financial reporting, urging companies to adopt rigorous internal controls and comply with regulatory requirements. The Enron scandal serves as a reminder that ethics and integrity should always guide business decisions, and any deviation from these principles can lead to catastrophic consequences.